thank you for joining us. We will be discussing the macroeconomy, the national multifamily industry, and some of the big trends that we're seeing across the industry. This is a new format and a new medium for us. We'll be coming to you with a series of video updates over the coming months, and we're really excited to be launching our new Radix video series. So where are we as we kind of wrap up the month of January and look ahead to the rest of 2023? Well, certainly coming out of 2022, it was quite a choppy year for the economy and the multifamily industry as well. We had a recession. As many economists have said, we weren't in a recession. Some economists have said we were in a recession. I believe we were. The definition of a recession, for as long as many of us have been tracking the economy, is 2 negative quarters consecutively of GDP growth. And we saw that last year. The first and second quarters were negative on an annualized GDP basis. And so we were in a slight recession. Now, I emphasize the slight aspect of that because it wasn't a significant recession. Most of that is because of how strong the labor market was and how strong the labor market continues to be. We've seen more than 200,000 new jobs added throughout 2021 and 2022, and our unemployment rate remains at about 3.5%. So overall, from a macro perspective, the employment market is very strong, very tight employment market, and that's what's continued to be the backbone of our economy. Now, inflation has certainly weighed on the multifamily industry as well as the economy as a whole. We saw gas prices spike last summer. We continue to see inflation. But one of the positive things that I see coming out of the economy right now is that it looks like things have peaked. Inflation seems to have peaked last June. Certain interest rates like the 10-year Treasury seems to have peaked. The one aspect that doesn't seem to have peaked is the Fed and their movement for the Fed funds target rate, the short end of the yield curve that they can control. Even though inflation is coming down, even though inflation has peaked, it does appear that the Fed is going to continue to raise rates as soon as next week. They'll meet in early February, they'll meet again in March, and I expect them to continue to raise rates, even if it's at a slower pace than last year, for much of the coming months until we see overall inflation on an annual basis come back to that 2 to 3% range. Now, I do think the Fed is acting a little reactionary because we've started to see, and as I mentioned, we've already seen the peak in inflation. And in fact, December's month-over-month inflation showed negative growth. In fact, December's prices were cheaper than November's prices. Again, month-over-month deceleration in prices. So I think the Fed is acting a little reactionary, but it's certainly having the ripple effect in the economy that it was looking for. Both the economy and the real estate market are struggling with higher interest rates, challenges to borrow, both corporate borrowing, real estate borrowing, single-family home borrowing. The mortgage rates have jumped by about 100% since early last year. Home prices have not come down accordingly, and so the cost for homeowners purchasing new homes is even higher than it was a year ago. This is actually a good thing for the multifamily industry, as it should keep demand a little bit higher for our industry than it had been. So overall, when I look at the economy, I think we're in a decent place. I think 2023 will continue to have some volatility, even though inflation is coming down. GDP may fall negative again. We may fall into a slight recession. Employment is starting to show signs of weakness, as many of the headlines have garnered. The tech sector and the financial sector are laying off significant employees. I see that really as a reaction to significant hiring that was made in late 2020 and early 2021 to combat the rapid growth coming out of the COVID recession. So you see many of the big tech firms laying off employees, many of the banks, large banks and financial institutions are laying off employees. But again, I expect the overall employment market to remain strong as we still have a very, very tight job market, very, very low unemployment rate. So switching gears to multifamily, we're starting to see things normalize. So last year, returned to normalcy for some key trends like traffic and leases. We saw a significant or a steady run up in traffic and leases through the first half of the year, which is typical of a multifamily prime rental season. Things flattened out through the middle of the year, and then things softened off towards the third and fourth quarter, with some of those metrics declining. Now, it looks like there's stabilization in both traffic and leases emerging at the early part of this year. I expect another decent rental season from March to June for most of the country. Occupancy has been trending downwards significantly since the end of 2021 when it reached an all-time high. But overall, I start to see occupancy flattening out as well in kind of the mid-94 range nationwide. Some markets a little bit higher, some markets a little bit lower. There are a couple markets that have new supply constraints: Phoenix, Las Vegas, Houston, where occupancy has dipped into the 93% range, and that is a little bit concerning. But I expect those markets to do okay over the long term as they absorb the new supply. New supply is once again a factor. Really, we didn't have to worry about new supply in 2020, 2021, early 2022, when demand was just through the roof at historical levels. That is no longer the case. Demand is starting to return to pre-COVID levels, come back down to where it had been, and we're starting to see occupancy dip in places that are heavy in new supply. We expect to see upwards of 400,000 new units delivered this year, so there will be pockets of weakness based on that new supply. But again, overall, I think the strength of the multifamily market is pretty good from an operational perspective. We see a steady demand for housing. The NMHC still forecasts we need between 3.5 and 4 million units delivered over the next 12 years. And so while we do face some short-term supply pressures, I think the demand for multifamily and the demand for our industry will remain pretty steady and pretty strong in the coming decade. The gateway markets will likely do a little bit worse than the Sunbelt markets. I see continued job formation, continued migration growth, and continued relocation to those Sunbelt markets where the business-friendly climate is a little bit softer and a little bit more friendly than perhaps some of the Northeastern and West Coast markets. From an operations perspective, I think it'll be a steady year, again, a return to normalcy, but I see that as a good sign for the multifamily sector. If we were to remain in the rapid growth phases that we saw in 2020 or late 2020 and into 2021, I expect we would see significantly more regulatory pressure on our industry than we're seeing today. Not to say that there isn't regulatory pressure that's beginning to bubble up on the margins. But overall, I see the industry in a pretty stable position, and I look forward to sharing more of our economic and market insights with you in the coming months.